Good morning, Mom. Good morning, classmate. So we are the Group 8 and we will be reporting about audit in finance and accounting function. So, as we start, let me introduce first the topic. Internal auditing has traditionally been associated with finance and accounting. A financial statement audit's goal is to give credibility to a firm's reported financial status and performance. Even if the auditor's job is effective in all parts of the organization's operations, it always comes back to the accounting functions and record they retain. This practice primarily involves checking business accounting records, internal control policies, and other major business financial concerns. The operational sections of the company must interact with the accounting department because all operations must be accounted for. Each transaction and each registered event should be based on appropriate documentation. The audit should review each document and each event whether they are appropriately accounted for. Businesses must follow and obey the legal regulations and ensure proper disclosure of all events related to financial and accounting operations. The audit of the financial operations is of particular importance because it brings to it the knowledge of how the financial assets and how the business entity achieved the financial result, how the profit from the operation was distributed, and etc. The most important thing for successful financial operations is to have a good and solid organizational setup, proper subordinate documentation, and an efficient way of checking the documentation. The internal audit of the financial operations of the businesses contributes to improving the efficiency of the business entity. Through promotion and confirmation of the accuracy and reliability of the accounting and operational data and information that are the basis for making quality business decisions. Defining the finance and accounting universe. There are several ways an auditor can define the constituent elements of finance and accounting within an organization. For example, functionally, based upon the discrete accounting departments that are in place, and perhaps as recorded on the internal telephone list, or in terms of the financial cycles, such as the revenue cycle, the expenditure cycle, or the treasury cycle. When opposed to the functional method, the cycle approach in the financial cycle has one possible benefit. It accounts for the unavoidable flow of data across functional boundaries, where control is typically at its weakest. This might be described as a cradle-to-grave evaluation. The internal auditor should constantly be aware of the input and output interfaces that exist between the function under review and those who interact with it while using the functional method. Considering that the financial and accounting is very extensive, this report will elaborate on the following possible breakdown of the key functions, systems, or activities: treasury, payroll, accounts receivable, accounts payable, general ledger or management accounts, fixed assets and capital charges, budgeting and monitoring, bank accounts and banking arrangement, sales tax or VAT accounting, taxation, inventories, product or project accounting, petty cash and expenses, financial information and reporting, and lastly, investment. Control objectives and risk and control issues. Part of the terminology that we hear over and over again in audit is called control objectives. Control objectives are statements that describe how a company will successfully manage risk. The auditor will check to see if the business has met these control objectives. Internal control objectives are desirable goals or circumstances for a certain event cycle that it met, reduce the risk of waste, loss, illegal use, or misappropriation. These are the requirements that the internal control system must meet. Compliance with a control aim must be measured and observable for it to be effective. The control objectives may include the following: authorization. The objective is to ensure that all transactions are approved by responsible personnel following specific or general authority before the transaction is recorded. Completeness. The objective is to ensure that no valid transactions have been omitted from the accounting records, that financial statements are comprehensive, include every item, inventory, or transaction that must be shown after an accounting period, even those temporarily held by a third party. Accuracy. The objective is to ensure that all valid transactions are accurate, consistent with the originating transaction data and information is recorded on time, that all figures are accurate and based on proper valuations of assets, liabilities, and balances, and that they are classified appropriately. Validity. The objective is to ensure that all recorded transactions fairly represent the economic events that occurred, are lawful, and have been executed under management's general authorization. Physical safeguards and security. The objective is to ensure that access to physical assets and information systems is controlled and properly restricted to authorized personnel. Error handling. The objective is to ensure that errors detected at any stage of processing receive prompt corrective action and are reported to have appropriate level of management. Segregation of duties. The objective is to ensure that duties are assigned to individuals in a manner that ensures that no one individual can control both the recording functions and the procedures relative to processing the transaction. Existence or occurrence. The objective is to ensure that the liabilities, assets, and shareholders' equity presented on financial statements exist at the end of the accounting period. Presentation and disclosure. All financial informations and disclosures are included in the statement and presented in a transparent manner that can be easily understood. Risk and control issues. Following the identification of a control objective, the risk associated with that control objective may be specified. In the majority of situations, each control objective is linked to one risk. It is possible, however, that it is connected with more than one risk. A risk is something that could jeopardize the achievement of an objective. Internal control risks are those that compromise the efficacy and efficiency of internal controls, therefore threaten the achievement of goals and objectives. The risk and control issues will be further discussed in the next slide, which would offer a general understanding of the expected elements for each activity.
Treasury is a critical component of financial strategy since it serves as the link between the firm and its financial sources. It is crucial to ensure that a business successfully manages its financial risk. The Treasury function's primary purpose is to assist the Board of Directors and management on business choices and financial issues that are critical to the company's overall strategy. Securing finance, retaining funds, and managing risk are critical Treasury competencies that allow strategy execution. Effective oversight of Treasury activities necessitates a clear description of the organization's strategic and financial objectives as well as risk management procedures. The following are the control objectives and risk and control issues for Treasury. Under authorization, the control objective is to prevent the processing of unauthorized and fraudulent transactions by verifying that all Treasury transactions are of the approved type and within the established limits for individual transactions. Under completeness, it should be considered that all Treasury transactions and fund movements are accurately accounted for, correctly recorded in the accounting system, and has been reported to the management, as well as establishing adequate independent and timely Treasury monitoring facilities and identifying, recording, and correctly accounting for all maturing funds or investment, income, and interest receipts. The control objectives for segregation of duties is to ensure that the Treasury staffs are suitably experienced and qualified to operate within the limits of established policy and practices by providing suitably trained Treasury personnel and the other necessary resources to ensure that the company's objectives are achieved. Another control objectives under segregation of duties is to ensure that Treasury activities are monitored as part of an overall view of risk management by providing adequate accurate, relevant, and timely data to support the decision-making and trading activities of the company, as well as establishing and communicating the objectives for the treasury functions clearly. For the compliance, the control objective is to ensure that suitable and secure investments, financial instruments, etc. are utilized to the maximum benefit of the organization and within the constraints of the prevailing laws and regulations by ensuring that all relevant laws and regulations are being complied. Under existence, the control objective is to ensure that the organization's funds are appropriately managed with the aim of providing adequate levels of working capital through establishing and issuing written policy governing treasury operations, authorized transaction types, financial limits, etc., and establishing formal written treasury procedures to support the aims of the agreed treasury policy, as well as defining, communicating, monitoring, and reacting to working capital requirements. For the validity, it should be considered that all treasury transactions are supported with accurate documentation, authorization if it is required, and effective audit trails. Treasury policies are framework that allows the board of directors and management to delegate financial decisions regarding the company in a regulated way. It should provide clear rules on their areas of duties on how they should carry out their task, what their boundaries are, and how their performance will be assessed to those in charge of treasury activities. The Treasury Policy document should explain the organization's financial risk management objectives, which should reflect its goals, risk tolerance, and source of risk for the specific business and the economic environment in which it operates, as well as the risk management framework to be adopted by the organization.
Good day, everyone. Another scope that is included in the auditing finance and accounting function is payroll. In our culture, especially here in the Philippines, we don't talk openly about pay, but it's one of the most important factors of finding and leaving a job. We define payroll as a compensation a business must pay to its employee for a set period and on a given date. So basically this includes the money that the employee received in exchange for their services. In order to evaluate the control system, the auditor will firstly consider the objective and risk which the control activities should be designed to achieve. For payroll, we consider the validity, completeness, accuracy, and the authorization as a substantive testing to ensure that the associated risk will be controlled. For the first one, it's the validity. So for the control objective of validity, it is to ensure that only valid employees are paid at the correct and authorized rate. For the risk and control issue, what mechanisms prevent payroll payment being made to invalid or unauthorized persons? The auditor needs an assurance that payment for payroll are being made to valid employees for time work. Not only do they need to be valid employees, they also need to be valid employees that did work and therefore are being compensated for the work being done. So for completeness, control objective is to ensure that all deductions are correctly disbursed. And for the risk and control issues, how does management verify that all payroll transactions are correctly reflected in the accounting system in the proper accounting period? Payroll software should automatically transfer total wage costs and deductions such as tax and pension contributions to the appropriate accounts in the general ledger. For the third one, it's accuracy. For accuracy, the control objectives are to ensure that calculations of all payments and deductions are correct in accord with the relevant taxation and other regulations and requirements. It is also to ensure that all payroll transactions are accurately reflected in the accounting system. It is also ensured that regular and accurate management and statutory information is produced. For the risk and control issues, how does management ensure that amounts paid via payroll are correctly calculated? Is management provided with accurate payroll cost data on regular basis to support their decision making? Employees deserve accurate pay records. Each paycheck should come with a payslip that gives them the details of their pay including hours worked, overtime paid, and explanation of all deductions. Auditors basically go through and make sure that the calculations of all these types of items are tying out correctly, and we can use various basic techniques to consider the accuracy of the payroll process classification. For the last one, the authorization. For the authorization, the objective is to ensure that unauthorized access to the payroll system and data is prevented. For the risk and control issues, how does management confirm that income taxation and other deductions are accurately calculated and disbursed? Access to master file should require a responsible official's password and a log of standing data. Amendments should be produced and reviewed. An independent check should be performed of outstanding data amendments logged to supporting documentations. So for the next one, another scope that also is included in the auditing finance and accounting function is taxation. Auditor can sound scary like the taxation, and sometimes they are when government officials show up at your door to do one. But most payroll audits are internal checks on the accuracy of the data. So for the taxation, we defined it as an examination of your tax return to verify that your income and deductions are accurate. The process of verification and its inspection of the accounts of a taxpayer to confirm that their adherence to the provision of the income tax law. So like payroll, for the payroll, we consider compliance, completion, validity, and presentation as a substantive testing approach to ensure that associated risk will be controlled. For the compliance, the control objective is to ensure compliance with all the relevant taxation legislation and regulations, and it's also to ensure clear objectives are established in relation to taxation matters with a view to minimizing tax liabilities within the confines of the prevailing legislation and regulations. The risk and control issues are: what measures ensure that taxation liabilities are minimized within the prevailing regulations, and how does management ensure that all required regulations are satisfactorily complied with? The objective of an audit of the tax affairs of a business is to establish if that business has paid the correct tax at the right time in accordance with the domestic tax legislation. This function has in the past been performed by auditors from both private and public sectors. The next one is the accuracy. For the accuracy, the objective ensures that all allowance and concessions are identified accurately, assessed, and accordingly claimed. For the risk and control, is management supplied with regular and accurate data on corporate taxation liabilities as means to support decision making? What process prevent the unauthorized or incorrect settlement of taxes? And are all taxation returns accurately supported by the underlying accounting system data? For the completion, the control objective is to ensure that all required taxation returns are correctly filed. For the next one, for number 4 is the validity. For the control objectives, to ensure that all tax liabilities are accurately determined and supported by accounting data, and also to ensure that all tax payments are suitably authorized. All tax auditors need to obtain reasonable assurance that tax returns are free from any material misstatement, whether due to fraud or error. An auditor must obtain and evaluate the available audit evidence as part of the assurance process in order to reach the opinion to whether or not tax return is correct. For the last one, it's the presentation. For the objective, to provide management with adequate and accurate information of tax matters and liabilities. And for the other control objectives, to ensure that all tax affairs are appropriately planned and managed. Ensure that all affairs are appropriately planned and managed. Evaluate and analyze accounting system and tax control units to reduce taxes. Auditors' involvement on tax planning ensure that all elements work together to allow you to pay at the lowest tax possible.
Okay. So for accounts payable, we also have internal controls to do to prevent risk from happening. First, we need to take a look on the approval of purchase request. We should consider who approved it. Was the person who approved really the right person to approve that particular transaction? Okay, so it is not enough that there is an approval. What's important is that we should look carefully on who is doing the approval. There should be right authority. Moreover, we should select a random sample of purchases and vouch it to the purchase request. The amounts must match together. When it comes to ordering, we must review the list of suppliers. We need to see to it that we will only consider the appropriate and approved suppliers. When receiving the goods, we need to make sure that the ones we receive are the actually ones we ordered. We may also need to check that receiving reports are actually being completed by searching for paper or electronic records. Part of the internal control is the three-way match. What is this three-way match? This is composed of the purchase order, the receiving report, and the invoice. It is crucial to check whether these documents contain the same information. We also need to look for proofs such as paperwork, voucher, package. If you made payment through check, there is a need to review if the signatories are authorized. While if you made an electronic fund transfer, it is important to obtain proof that it was released by an appropriate staff member. Okay, so here are some substantive testing approaches that we can apply for accounts payable. First, we have existence. This approach will help us attain one of our objectives, which is to ensure that all payments are for valid and suitably approved creditor accounts for goods and services actually received. We should conduct external confirmation that we owe money to a particular supplier. Moreover, we need to select a sample of accounts payable and vouch it to the goods invoiced, received, and ordered. The prices and quantity of goods should be correct, or it should be the same. In these ways, we can ensure that only valid invoices are paid where the goods and services have been fully and correctly received, and also invoices are authorized prior to payment and confirmed as being within the agreed budget. We also have completeness. Here, we trace a sample of purchase requests to approval, purchase orders, receiving reports, invoices, and even journal entries. We should check that journal entries uses the correct accounts and correct amounts. In this way, we can ensure that the values of paid accounts and outstanding invoice liabilities are accurately and completely reflected in the accounting system, and that all invoices were identified, recorded, trailed, and accounted for. Moreover, we have the accuracy and valuation allocation. This will lead us to our objectives, which are to ensure that all payments are correct and accurately reflected in the accounting system, and to ensure that the prevailing sales tax or VAT regulations are correctly complied with. So under this, we should compare accounts payable balance to monthly statement from suppliers. Moreover, we need to review a sample of supplier invoices and inspect for unusual payment terms. Also, we need to see to it that proper treatment of tax is followed and prevailing requirements are met. Lastly, in terms of presentation, we need to make sure that everything is presented in accordance with the standards. Okay, so here are some other control objectives for accounts payable. First, to ensure that good relationships are maintained with key suppliers, and also to prevent the possibility of supplier or staff malpractice. So if you think that something unusual is going on, you need to go to the suppliers and do cross-referencing. Now for the accounts receivable, we also have substantive testing approaches to attain our objectives and prevent or minimize risks. Okay, so first we have existence. We need to make sure that the customers really exist. Here we have to select a sample of accounts receivable and send a debtor's confirmation. We can also do testing from sales. So in these ways, we will be able to see that transactions were real and did occur. Okay, so secondly, we have completeness. This will help us ensure that all invoices are paid and the income is correctly identified and accounted for, and of course, reflected in the accounts. We can use the sales audit procedures to check if this objective was met. Next, we have accuracy and valuation allocation. We need to recalculate to make sure that proper valuation were made. Moreover, we must identify all income generating activities and accurately invoice to customers. And lastly, we have the presentation. This includes the appropriate recognition of provisions for bad debts. There are also other risks which can be prevented through controls such as trading involvement with financially unstable or unsuitable customers, and output VAT issues. Okay, so furthermore, the risk of overdue accounts can be prevented by promptly identifying and reporting to the management. On the other hand, other controls include daily checking of bank transactions if payments of accounts receivable is through direct deposit, and also journal entries to record payments should have supporting evidences and must be reviewed. So overall, auditors should see to it that there was an approved process, payment terms are followed, and policies were followed in terms of the amount.
Moving on, a general ledger is the foundation of a system that we employ as accountants to store and organize financial data that are later on used to create a company's financial statements. In bookkeeping, a general ledger, also known as a nominal ledger, is a tool wherein accountable events or economic events are posted from a journal. As defined by the company's chart of accounts, transactions are posted to individual subledger accounts, and the accounting effects of all the economic events within the organization are eventually reflected in the general ledger system. The general ledgering system will be used to generate financial information for both consumption of the internal and external users, wherein internal users are provided with the management accounts for purposes of forecasting and aids in decision making. By then, the overall structure and integrity of the general ledger system are of critical issues. The objectives for the general ledger are to ensure that accurate, timely, and complete financial information is captured, maintained, and reported to facilitate effective decision making. Accordingly, internal auditors do controls to help safeguard an organization and further its objectives. Control functions to minimize risk and protect assets, ensure accuracy of records, promote operational efficiency, and encourage adherence to policies, rules, regulations, and laws. And one control objective under the general ledger is accuracy, as to ensure that the general ledger and management accounts are accurate, reliable, and appropriately reflect the structure and operations of the organization. Question that arises regarding risk and control issues for accuracy includes: how does the management ascertain that the general ledger accounting data is accurate, complete, and up to date, as well as how management verifies that all summaries and analysis of accounting data are accurate and reliable? Another is validity, to ensure that the accounting data is capable of meaningful and accurate analysis in order to support management decisions and actions. The question regarding how to provide timely, accurate, and relevant accounting information to support decisions and actions must be answered by the management. Moreover, compliance is also a control objective, as to ensure that the accounting records are maintained in accordance with the prevailing laws, regulations, and professional good practice. Proper disclosure and presentation must also be made to ensure that the accounting information can be used to generate all the required statutory published accounting statements, in which questions regarding the accuracy of published and statutory accounting statements must be confirmed. Other control objectives under general ledger and management accounts may include physical safeguards and security that knows what mechanisms will be ensured to protect the organization's accounting data from loss, unauthorized amendment, or leakage. Another is authorization, answering the question on the approval by senior management of the chart of accounts and how it suitably reflects the organization and the operations of the company. Further is bank accounts and banking arrangements. This function is a subject area that affects all businesses, and thus due attention should be paid to the control and monitoring of account usage, especially where there are devolved authorities such as check signatories and fund transfers. Regular, independent, and effective account reconciliations must also be made to internal control records, as they can limit the possibility of undetected defalcation. If the bank statement and the general ledger don't agree, then the reconciliation document should fix the discrepancy, but if the reconciliation statement is wrong, then further investigation must be made. Generally, the variety of account types and the range of other services offered by the wider financial services community make a critical selection of the appropriate account arrangements, considering the type of banking facilities best suited to both the operational and financial needs of the business. Safeguarding bank assets along with limiting or controlling risks to achieve the bank's objectives are included in the internal controls implemented by the board and senior management of a company to effectively prevent or detect mistake, potential fraud, or non-compliance with bank policies. The following control objectives must be made to consider such. First is authorization, to ensure that fund transfers and automated methods of effecting banking transactions are valid in the best interest of the organization and authorized, as well as all banking transactions are bona fide, accurate, and authorized whenever necessary to ensure the overdraft facilities are authorized and are accurately operated within the limits defined by the management and the organization's bankers. Related risk and control issues regarding these may include: how is the management assured that all banking transactions are accurate, complete, and authorized whenever necessary, Or have there been written procedures governing the setup and use of banking facilities been established and implemented? Other risks include others of the following. Completeness, on the another note, has something to do with ensuring that all income is banked and is without delay, and answers regarding all bank account activities and balances are taken into account within treasury function must be ensured by the management. Error handling, on the other hand, covers ensuring that banking charges are effectively monitored and minimized, and to ensure this, prevailing banking terms and conditions must be optimized in terms of account type, transaction levels, interest payable on balances, level of charges, and the others. Segregation of duties is another objective to ensure that potential for staff malpractice and fraud are minimized. Other control objectives also include physical safeguards and security, ensuring that mechanisms utilized in preventing the unauthorized setup and operation of a bank account are made. Another control objective is regarding accuracy, that ensures that banking arrangements and facilities are appropriate and adequate for the business. And risk control issues regarding these are usually asked by how the management is aware of all active corporate bank accounts, their purpose, and current status.
For the fixed assets, I am Glaezee and Duran, your reporter for this part. Fixed assets refer to long-term tangible assets that are used in the operations of a business. Examples: land, machinery, buildings and facilities, vehicles, furniture, office and computer equipment, and tools. So fixed assets provide long-term financial benefits. They have a useful life of more than 1 year, and they're also classified as property, plant, and equipment on the balance sheet. For the capital charges, a capital charge is the return a project must realize to cover the cost of the capital it uses. It is significant because it is used to calculate economic profit. Now let's move on to the control objectives and risk and control issues of fixed asset and capital charges. So basically, control objectives are identified in order to address the risk and control issues that I am going to mention later regarding fixed assets and capital charges. So the following objectives and issues are classified or grouped according to their particular substantive testing approach. So number one, for completeness. So under this, inspection of fixed assets as well as verification of occurrence or verifying that fixed asset transactions actually took place is one of those ways that you need to consider. You could vouch them to supporting documents in which it correctly and accurately reflects on the balance sheet. Even those reserves for the replacement of key assets. What are those reserves? These are profits appropriated for a particular purpose. It is used to purchase fixed assets, pay an expected legal settlement, pay bonuses, pay off debt, pay of repairs and maintenance, and so forth. All those transactions need to be presented in the financial statement. So in order to prove or verify that such transactions really occurred, you need to examine supporting documents. Second, for authorization, the justification of capital expenditure ensures that those expenditures are in accordance with the company policy and does not jeopardize the financial being of the company. Certain criteria and methods or procedures are needed in order for the capital expenditures to be approved. It should be approved by responsible personnel in accordance with a specific or general authority. Next, accuracy. Fixed assets need to be accurate, consistent with the originating transaction data and information is recorded in a timely manner. Fourth, validity. To do so, the auditor should select a sample of fixed asset disposals to check if they all have a proper authorization. The authorization is also necessary to address whether the company follows proper internal control and conform with the management's general authorization when approving the purchase or disposal of fixed assets. Next, for the physical safeguards and security, so here, certain procedures will be conducted for periodic audit of assets to ensure their continued protection. Next, for the presentation and disclosure or the compliance, Depreciation methods should also undergo to certain criteria and procedures to ensure that those methods conform with the generally accepted accounting principles or GAAP and are consistent with the prior period and also presented in a transparent manner in order for it to be easily understood.
Budgeting and monitoring. It includes a general budgeting framework. Example of this is how the budgets are initially generated, authorized, and rolled out, and the allocated responsibilities for subsequently monitoring actual performance against budgets. Example of these are identifying and reacting to significant variances, authorizing budget amendments, etc. Monitoring the budget is important to ensure that the financial, operational, and capital plans that were developed and approved for implementation as part of the budget processes are being implemented. Budget monitoring is crucial for an organization to be able to enforce accountability related to spending. Control objectives and risk and control issues. Existence, control objective, to provide an accurate and reliable budgeting system as a means to ensure that a good financial and business objectives are achieved. Risk and control issues. Has management developed and implemented a documented budgeting process for use throughout the organization, and does this clearly allocate responsibilities for action and follow-up of variances, etc.? How is the budget and actual data reflected by the budget system confirmed as accurate and complete? Completeness, control objective, to provide a realistic and accurate budgeting framework and plan, which accurately reflects the structure and operation of the organization. Risk and control issues. How is management certain that the budgeting model and processes adequately and accurately reflect the structure and operations of the organization? How is the accuracy and completeness of data input from other sources system confirmed? Validity, control objective, to provide management with the means to monitor progress against financial targets. Risk and control issue. Are the budgeted figures agreed by the relevant members of management, and how is this signified? How does management ascertain that all subsequent amendments to the budgeted data are justified, authorized, and accurately applied? Is the budget information produced and circulated on a timely basis? Error handling, control objective, to ensure that variations, deviations, and failures to achieve targets are promptly identified for management action. Risk and control issues. Are significant budget versus actual variations identified and promptly acted upon? How is the action taken in reaction to variations, shortfalls, etc., verified as complete and effective?
Hello guys, we now move on to sales tax accounting, and this section uses the value-added tax environment as a standard model, and it can easily be modified and applied to other sales taxation regimes. As a background, value-added tax is a form of sales tax. It is a tax on consumption levied on the sale, barter, exchange, or lease of goods or properties and services in the Philippines and on importation of goods into the Philippines. We have here the control objectives, which focuses on the accuracy of data and records. Letter A is to ensure that all valid input and output VAT is accurately identified at the appropriate rate, recorded and reported. Input VAT is for your purchases, while output VAT is charged on your sales. Where the output VAT is more than input VAT, the situation to pay VAT arises. In sales tax audit, the auditor will be reviewing sales transactions to determine if the proper tax rate was charged to the customer. And next one, to ensure that the correct net value of VAT is either reclaimed or paid over and supported by the relevant return. A business can make a VAT reclaim by deducting it from its output tax liability while preparing the VAT return. If the input tax exceeds the output tax, then the business shall be eligible for a refund. Auditors must check the data recorded if they are really accurate. And next, ensure that the prevailing VAT regulations are correctly observed at all times. Here are some requirements needed to be complied. Number 1, registration of book of accounts. Number 2, VAT official receipt or VAT sales invoice. Number 3, substantiation of VAT input claims, wherein we have the simple rule that is no substantiation, no deducting of input VAT. Number 4, filing of VAT returns in the Philippines. And number 5, filing of quarterly summary list of sales and purchases. And the last objective we have is to ensure that the business remains correctly registered for VAT and correctly displays its registration number on all relevant documentation. We now go to the risk and control issues for sales tax. Number 1 is how does management ensure that all output VAT and duty on applicable sales is accurately identified, accounted for, and duly reported. The same goes on input VAT here in number 2. So in relation to this, some vendors may not transmit sufficient detail to the credit card company to determine if sales tax was paid at the time of purchase. Therefore, taxpayers should have other measures such as keeping receipts to support tax determination. Taxpayers should designate a primary contact person for the audit and inform other teams that their assistance may be needed to retrieve documents requested by the auditor. Number 3 is what processes ensure that all required VAT returns are accurately prepared in accordance with the current legislation. And number 4, how does management ensure that the correct net value is either reclaimed or paid over to customs and excise? As the focus in many audits is on underpayments of tax rather than overpayment errors, the taxpayer may want to consider performing a reverse audit to determine if there are opportunities for refunds. And if a refund claim is identified, the taxpayer will need to determine the correct way to proceed with the refund claim. Number 5 is the current company registration for VAT correct and up to date? And number 6, have contingency plans and practical arrangements been made to cater for implementing variations in VAT rate? If the taxpayer does business in multiple jurisdictions, it can be challenging to maintain updated sales tax rate tables. Taxpayers should review their internal processes for updating tax rate tables, and there should be a control process restricting a personnel who have access to the rate tables and ability to change tax rates. If the audit uncovers errors in the rates charged to customers, the taxpayer is unlikely to recover any additional tax from the customer. Number 7, what mechanisms ensure that all the required VAT returns are correctly completed and dispatched on time? The BIR has the requirements in filing of VAT returns that must be complied by the VAT registered business. And the last one is, does the correct VAT registration number appear on all the relevant company stationery and documentation? That's it for sales tax accounting, and thank you.
Inventories. As defined in past 2, paragraph 6, inventories are assets held for sale in the ordinary course of business, in the process of production for such sale, or in the form of materials or supplies to be consumed in the production process, or in the rendering of services. If you notice here, it must be held for sale in the ordinary course of business. It is the finished goods, for example, in the manufacturing companies or the merchandising companies that items are held for sale. They buy it from the supplier, then they sell it again. The next one, in the process of production for such sale, there is also in work of process, and the third one we called it raw materials. It is the factory supplies to be consumed in the production of process. All of these are belong to the inventories. For the compliance, the control objectives is to ensure a continuous supply of materials and stock so that production should not suffer at the time of customers' demand, to maintain the availability of materials whenever and wherever required in enough quantity, to supply the required materials continuously, to minimize loss through deterioration, pilferage, wastages, and damages. For risk and control issues, how do unreliable suppliers affect the business? An unreliable supplier is when they cut one lead time, then deliver early or late, meaning you fluctuate from having too much to too little stock. The wider the gap between early and late deliveries, the greater the level of risk and uncertainty. For the completeness, the control objectives is to maintain minimum working capital as required for operational and sales activities, to optimize various costs indulged with inventories like purchase costs, carrying costs, storage costs, etc., to avoid both overstocking and understocking of inventory, to eliminate duplication in ordering stocks. For risk and control issues, how to reduce inventories losses with a better shelf life. Perishable goods and products with a shelf life pose another risk to inventory control. The shorter a product shelf life, the greater the inventory risk. For manufacturers, This requires robust manufacturing and inventory control practices. For the accuracy, the control objectives is to ensure the quality of goods at reasonable prices, to keep material costs under control as they contribute to reducing the cost of production. For the risk and control issues, what are the implications of inaccurate forecasting from interpreting data? Inaccurate sales prediction or failing to anticipate surges or truths in customers' demand can lead to an undersupply or oversupply of inventory, both of which can have negative consequences. And lastly, authorization. The control objectives is to facilitate furnishing of data for short and long-term planning with a controlled inventory, to ensure everlasting inventory control so that materials shown in stock ledgers should be physically lying in the warehouse, to maintain a systematic record inventory. The risk and control issues: how secure is inventory from theft? How do companies face future losses in the inventory? Inventory loss occur in the form of the physical loss of a product or when error occurs during the receipt of goods. Goods can get lost through poor inventory control or mishandling by employees. Therefore, to avoid the loss in the future, we should consider collaborating with other similar small businesses. We can work with other businesses on issues like audit practices, loss evaluation, and using statistical ways of tracking trends. We could also collaborate on human resources, operation, risk management, and other related issues. One of the biggest risks associated with inventory control is theft, especially when it comes to high-value inventory stock. Occasional inspection and audits of inventory will help prevent fraud and theft. Like your accounting audits, make these inventories check a surprise. These audits will keep records current and make it easier to detect theft.
Product or project accounting, sometimes referred to as project management. Project accounting provides for the ability to maintain tight control over project direction, cost, execution, and budget. It also supports resources effectively and ensure accurate billing and accounting. It can be considered as another subsidiary ledger that contains the activities associated with all of the projects provided to clients within the firm. Control objectives and risk and control issues for product or project accounting. Authorization. Control objective. To ensure that all projects and products developments or launches are suitably authorized as part of the strategic direction of the organization. Risk and control issue. Are all products, developments, or projects authorized and ratified by senior management as part of the long-term strategic direction of the organization, and what prevents unauthorized product or project activity? Completeness. Control objective. To ensure that the appropriate costing method is selected. Risk and control issues. Have key objectives been set for the product or project, such as the required rate of return on the investment or target sales income, as the basis for the performance and achievement monitoring? Has management established the most appropriate costing method for the product or project and ensured that all the relevant cost elements and underlying assumptions have been identified and incorporated? Accuracy. Control objective. To ensure that all the relevant costs are identified and accurately recorded. Risk and control issues. How is management certain that all the relevant cost data is accurate, complete, and being correctly accumulated in the accounting system? Validity. Control objective. To ensure local factors are appropriately taken into consideration, such as market share, price sensitivity, price controls, etc. To establish budgets based on reliable data and assumptions. To ensure the actual costs and progress are adequately monitored and that variances are identified and acted upon. To ensure that actual sales or project outturn performance is monitored and managed. To ensure that the accounting system accurately reflects all the relevant economic events associated with each product or project. Risk and control issues. Has management taken adequate account of local factors such as taxation, pricing controls, competitors, strategies, available subsidies and grants, etc.? Have key projects, milestones, and deliverables been identified and incorporated into a workable progress monitoring system for management review and accounting? How does management verify that it has accurately identified and made available all the required resources? Has management defined the break-even point for the product or project and established adequate monitoring of actual sales or performance to ensure achievement of their objectives? Other control objective, error handling, risk and control issue. How is management certain that cost overruns, failures to achieve target objectives, etc. will be promptly detected and followed up?
Petty cash are the most liquid form of cash. These are used to pay a small amount of expenditures, which usually vary between organizations, depending on their size and nature. These petty cash are often managed by the staff or employees for the payment of minor expenditures like office supplies. Surely, you can pay checks for a small amount of expenditure. As an internal auditor, although petty cash is generally small in amount, it is still important to make sure that the finance and accounting of these are still under control. This is because there are some instances where the staff mismanage the disbursement of petty cash, which may result to a loss. And there are also some instances where some staff or employees are tempted to take a small portion of the petty cash for their own personal expenses or personal gain, which is considered unethical. With that being said, these petty cash and expenses should be subject to test of controls in accordance with the general assertions of existence or occurrence, completeness, rights and obligations, valuation or allocation, and presentation and disclosure. The following are the control objectives with regards to the petty cash and expenses, along with the risk and control issues associated with it. There are three. So under the general assertion of existence or occurrence, the control objective is to ensure that all expenses are valid and authorized. So the internal auditors have to make sure that the recorded transactions involving petty cash and expenses really exist or really occurred. And the risk and control issues associated with it is first, how does management monitor that only valid, accurate, and authorized expenses are processed? And second is, what mechanisms prevent the acceptance and processing of invalid, unauthorized, or incorrect expenses? So the next control objective is under the general assertion of completeness, rights and obligations, and valuation or allocation. So the control objective is to ensure that all expenses are correctly identified, recorded, and accurately reflected in the accounting system. So internal auditors have to make sure that all the transactions involving petty cash and expenses are recorded, properly allocated, and make sure that the petty cash are really used for the minor expenditures of the entity. So the risk and control issues associated with it is first, are all petty cash floats identified and accounted for? Second, has management established clear policies and procedures for recording, authorizing, and processing petty cash and expense claims? And lastly, how does management confirm that all petty cash and expenses are correctly reflected in the accounting system? So down to the last control objective, it is in accordance with the general assertion of presentation and disclosure. So the control objective is to ensure that all expense payments are in accord with company policy and any relevant external regulations. So internal auditors should make sure that the accounting for the transactions involving petty cash and expenses comply with the necessary requirements and in accordance with the rules and regulations, which is usually the PFRS or PAS, as well as comply with the government requirements for the implementation of taxes like sales tax or VAT. So the only risk and control issue associated with it is how is compliance with the prevailing VAT or the equivalent sales tax regulations for expenses confirmed. So the proper implementation of control objectives will result to a properly disbursed and properly managed petty cash, which will improve the operations of the entity as well as add value to the organization. Observance of the control objectives will also mitigate all the risks and control issues that could manifest if there is a mismanagement of petty cash. With the implementation of control objectives, the key issues currently presented will be solved easily.
Let us talk about financial information and reporting. Financial information and reporting takes account of both internal and external financial reporting requirements. For external, we got the PFRSs, and for internal, we have the concepts we learned in managerial accounting. The key concerns of financial information and reporting relates to accuracy, completeness, timeliness, and security of the information. Now, we will discuss about the control objectives and risk and control issues for financial information and reporting. The first ones are related to accuracy and timeliness. The control objectives pertaining to accuracy and timeliness are: number 1, management is provided with accurate and timely financial information, which they will use to properly discharge their duties. And number 2, relevant financial reports and returns are accurately prepared and distributed to the external bodies. External users need accurate and timely information to assess the company they are investing to for stockholders and to assess if they are going to lend money if they are creditors. These two risk and control issues guides the auditors in finding out whether the accounting department creates accurate and timely information. Now, the second part talks about completeness and security. The control objectives for this part are: number 1, financial information is adequately protected from loss, misuse, or unauthorized leakage, and number 2, protection of sensitive or confidential corporate financial information. These two ensures that the financial information that is used to support the financial reports of the accounting department are complete and not prone to loss, misuse, or unauthorized leakage. These three risk and control issues guides the auditor in knowing the completeness and security of financial information. The management should ensure that financial data is protected because if it's lost, then we cannot identify and document all financial information requirements and we cannot ultimately release accurate financial data to external bodies. Lastly, we will talk about compliance. The control objective under this part is accounting records and statements are correctly maintained and prepared in accordance with accounting standards and good practice. Financial statements should be fairly stated. For the external financial reporting, we need to follow the FIFRSS. Moreover, our standards are principles-based, which needs professional judgment. The management, together with the accounting department, should use good practices in using professional judgments. The risk and control issues related about compliance is this too, which basically talks about how management ensures that they are complying with accounting standards and stated regulations. Now we're gonna talk about investments. Investments differ from as simple as investment in debt and equity securities to as complex as investment in associates, subsidiary, and so on. We will divide the discussion into three parts, which are 1. Investment decision making, 2. Compliance, and 3. Security. So first, we have investment decision making. The control objectives related to this are: number 1, investment decisions are researched in accordance with the established objectives. Number 2, investment commitments do not interfere with the required cash flow. And number 3, consider timescale and liquidity implications of investments. These three control objectives should be considered on deciding on where to invest, when to invest, and how much to invest. Next is the risk and control issues for investment decision making. Number 1 is to ensure that only suitable and authorized investments are made. Number 2 is to prevent investment commitments from adversely interfering with the day-to-day cash requirements. Number 3 is to establish an approved investment policy which clearly defines their objectives. The first three risk and control issues for investments talks about the investing strategy that the company wants. Number 1 makes sure that the selection of investments is in accordance with the objectives of the company. Number 2 talks about the limit of cash that should be used for investing. And number 3 talks about the time horizon of the investments, what the risk and return the company can take, and etc. For the compliance part, the control objectives are: invested funds and the income generated are correctly accounted for. And number 2, compliance to accounting standards and regulations. These two control objectives talk about how to account for different investments. I won't discuss this further because we had talked about this in our previous financial accounting subjects. The risk and control issues for compliance are the following: invested funds and the income generated from them are accurately accounted for, and ensure that investment income is maximized within the prevailing laws and regulations. And number 3 is that confirm that all investment comply with the relevant laws, regulations, and accounting standards. By using this, the auditor will know whether the management is complying to the laws, regulations, and accounting standards. The first one talks about the compliance with accounting standards, and the second and third mainly talks about maximization of profits while complying with pertinent laws which regulate investments. And lastly, we have security. The control objectives for this is investment documentation is adequately and securely stored. Because to report investment accurately, management should have investment documentation that is secured from loss and damage. And the recent control issue for the security of investment documentation is store investment documentation securely, because this makes sure that the investment documentations, which are very important evidence that the company indeed invests, are protected. These are very important because some investments such as stocks are intangible and nothing can prove its existence without investment documentations, together with documents relating to it such as their stock certificate.